Silver just crashed to $72. And I am going to be completely honest with you today. Not just about why it is crashing, but about exactly what I personally am doing with my own silver position right now. No hype, no cheerleading. Just the real picture and my real plan. Welcome to Money Insights. Let us get into this right now. Here are the cold, hard facts. As of today, March 20th, 2026, silver is trading at approximately $72.42 per ounce. That is a 21% drop in a single month. From the March high of $91.57 down to $72 in less than 3 weeks. On the MCX in India, silver dropped over 5% in a single intraday session yesterday, losing nearly 12,000 rupees per kilogram in hours. This is not a dip. This is a crash. And the question I am getting in every comment and every message right now is the same. Why is this happening? And what do I do? Let me answer the why first, because understanding why silver is crashing is the foundation of knowing what to do about it. There are 4 specific forces hitting silver simultaneously right now, and every single one of them is real. The first is the Federal Reserve. On March 18th, the Fed held rates and delivered a hawkish message. 7 FOMC members projected 0 rate cuts for all of 2026. The inflation forecast was revised upward, and Jerome Powell said the Fed is in no hurry. When the Fed signals higher for longer rates, the US dollar strengthens. And a stronger dollar is the single most powerful short-term enemy of silver, because silver is priced in dollars. When the dollar goes up, silver goes down mechanically. This is not a mystery. It is basic currency math. The second force is the Middle East war dynamic that is behaving the opposite of what most investors expected. Usually when war breaks out, silver goes up as a safe haven. But as Al Jazeera and Morningstar both reported, what failed this time was the assumption that assets widely seen as defensive would remain liquid under stress. When fear spikes to extreme levels, investors do not just buy safe havens, they also sell everything to raise cash. And silver, which had already rallied nearly 400% in a year, was sitting on enormous unrealized gains that investors wanted to lock in. Fear plus profit-taking plus a strong dollar is a brutal combination. The third force is what happened in January and its lasting damage. On January 30th, silver suffered one of the most violent single-day crashes in modern commodity history. Gold dropped 9%. Silver dropped as much as 35% intraday. $7 trillion in combined market value evaporated in a single session. As the Standard Chartered Global Commodities Research Head described it, both metals were trading in aggressively overbought territory. That crash broke something psychologically in the silver market. The speculative fast money that drove silver from $30 to $121 got completely wiped out. And the scar tissue from that event means that every subsequent rally gets sold more aggressively than it would have been before January 30th. Investors who got burned once are not letting their gains run anymore. They are selling into strength, and that creates a ceiling on every recovery attempt. The fourth force is profit-taking by the very investors who made enormous gains over the past year. Silver is still up more than 150% over the past 12 months, even at $72. The people who bought silver at $30 or $40 are sitting on life-changing gains. At some point, a rational investor takes those gains. And when enough rational investors take gains simultaneously, you get exactly what you're seeing right now. A waterfall decline that feels catastrophic, but is actually the natural exhale after an extraordinary rally. Now here is what most crash coverage is not telling you. The crash was not driven by a sudden change in fundamentals. Core inflation data did not suddenly shift. Industrial silver demand did not disappear. The supply deficit did not reverse. The 6 consecutive years of more silver consumed than mined did not become a surplus overnight. Naeem Aslam, CIO at Zay Capital Markets, said it directly. What failed was not the fundamental case for silver. What failed was the assumption about how silver would behave under extreme stress. The fundamental bull case is still intact. If you're finding this honest breakdown valuable right now, I want to ask you to do one quick thing. Hit the subscribe button and turn on notifications for Money Insights. We give you this kind of straight, honest analysis in real time, not after the fact when it is too late to matter. Hit subscribe right now. It is free, and it keeps you informed when these fast-moving situations develop. Now let me tell you my actual plan. Here is exactly what I am personally doing with my silver position during this crash. And I want to be clear that this is my personal approach based on my own financial situation and risk tolerance. This is not financial advice for you specifically. You need to make decisions based on your own circumstances. I am not selling my physical silver, not 1 ounce. Here is why. Everything I own in physical form I bought, understanding that silver is one of the most volatile assets in the world. I knew before I bought it that a 30% correction was possible at any time. Silver has corrected 45% in a bull market before, and then gone on to make new highs. My physical silver cannot be margin called. Nobody can force me to sell at the worst possible moment. And the structural reasons I bought silver, the supply deficit, the industrial demand, the monetary case, those have not changed. The paper price on my screen tells me what leverage traders are doing today. It does not tell me what my physical metal is worth to the industrial users who will need it next year and the year after. For my paper position, which I hold through an ETF, I'm watching the $70 level specifically. If silver closes below $70 on a daily basis, with high volume, that would be a technical signal that the next support at $64 to $63 is being tested. In that scenario, I would reduce my paper exposure, not eliminate it, reduce it. Because reducing exposure at a level that has been broken is risk management. Holding through a technical breakdown hoping for a recovery that may take months is not strategy. It is stubbornness. Here is the level-by-level picture of what I am watching for silver right now. The immediate support is $70. Below that, the next significant level is $64 to $63, which is where silver bottomed after the January 30th crash. Below that, the extreme support is $58 to $60, a level that multiple technical analysts describe as the absolute floor of the current bull market structure. If silver reaches $58 to $60, it would represent a 52% correction from the all-time high. Painful, but historically within the range of normal silver bull market corrections. In 1973 to 1975, silver corrected 45% inside the bull market that ultimately produced a 3,800% gain from start to finish. And here's the positive case that I want to make sure you hear alongside the honest risk picture. Deutsche Bank has raised the possibility of silver reaching $100 by year end, arguing that silver tends to outperform gold in the later stages of a metals bull cycle. JP Morgan has a gold target of $6,300 by end of 2026. At a gold to silver ratio of 60 to 1, that implies silver at $105. The supply deficit is still real. Fresnillo just cut production by 9%. China closed its refined silver export valve. And as WisdomTree's research head wrote this week, the buyer base for precious metals is broadening to include Chinese insurers, Indian pension funds, and digital and tokenized products. These forces are pushing prices into territory traditional valuation models struggle to capture. The investors who are selling silver at $72 today because they are afraid of $65 may be the same investors who were buying silver at $115 because they were afraid of missing $150. Fear and greed operating in the wrong direction at the wrong time is the single most reliable way to lose money in a volatile market. The investors who will benefit most from the next leg of this silver bull market are the ones who hold their physical positions through the correction, manage their paper risk intelligently with specific levels, and do not let a month of bad price action override the structural case that has been building for 6 consecutive years. My plan, in one sentence, is this: hold my physical silver completely, watch the $70 level on my paper position, and if prices reach the $63 to $64 zone, treat it as an accumulation opportunity within my budget, not a reason to panic. Before I close, I want to hear from you. Drop your answer in the comments right now. At what price would you feel confident adding more physical silver? 70, 65, 60? Your answer genuinely shapes what I cover next. And if this honest breakdown of the crash and my personal plan gave you a clearer picture of what to do right now, share this video with one other silver investor who needs to hear this before they make a fear-based decision. Every share helps Money Insights reach more people with honest analysis when they need it most. This has been Money Insights. Stay disciplined. See you in the next one.